Okay, thank you everyone for joining us for what I'm sure will be an engaging and timely discussion of fair lending and fintech. I'm Michelle Alt. I'm the co-founder of the Klaros Group and managing director of Klaros Advisors, where we focus on the future of financial services. We help financial innovators and incumbents define and achieve their business goals while meeting regulatory expectations. I'm very excited to be joined by my esteemed colleagues and friends, Dr. Marsha Courchane and attorney Andrea Mitchell. Marsha is vice president and practice leader of the financial economics practice at Charles River Associates. And she's also a leading expert in the areas of mortgage and consumer lending. She engages in research, consulting, and litigation support with respect to mortgage markets, discrimination in lending, consumer credit, credit scoring, credit risk, and redlining issues. So she has a very big plate. Marsha has published in numerous academic journals and is a member of Counselors in Real Estate and a fellow of the Weimar School of Advanced Studies in Real Estate and Land Economics. Marsha has also served as executive vice president of the American Real Estate and Urban Economics Association and held previous positions at Freddie Mac and the OCC, my alma mater, and various universities, including the University of Victoria, Canterbury University. Very cool. So Andrea is the managing partner and founding member of Mitchell Sandler, LLC. Let's hear it for women co-founders. She is a nationally recognized advisor to banks, financial service companies, and third-party service providers on enforcement and regulatory compliance matters. She represents clients throughout the country on fair lending, fair servicing, and responsible banking issues, including matters that involve disparate impact, disparate treatment, or unfair, deceptive, or abusive acts and practices, UDAP, as we all call it. So she also has a very big plate. Her work in these areas includes advising on redlining, pricing, underwriting, steering, product development, sales and marketing, social media, overdraft, other deposit account practices, credit reporting, servicing, collections, and loss mitigation. Andrea has conducted enterprise-wide investigations and served as lead counsel on dozens guys, of government investigations and enforcement matters. She has extensive experience in cases involving the CFPB, DOJ, the Fed, OCC, FDIC, FTC, HUD, state attorneys general, and state civil rights commissions, and live to tell the tale. Also, perhaps the coolest thing I know about Andrea is that she has a varsity letter in women's rowing. So don't mess with Andrea. So getting to our topic today, as Andrea and her colleagues wrote recently, predicting that regulatory and enforcement agencies will significantly increase their enforcement activity demonstrates our PhD in the obvious, which is a great line, Andrea. And here's why. The new CFPB director, Rohit Chopra, has a reputation for cracking down hard on financial services companies accused of consumer protection law violations. The FTC's new chair, Rebecca Kelly Slaughter, announced the agency's forthcoming focus on effective and efficient enforcement and racial equity. Kristin Clark, some of you may remember her. She is the new head of the Civil Rights Division at DOJ and has a long career pursuing fair lending cases in the government and nonprofit sectors. And the states are getting into the mix too. For example, California has just launched its own Department of Financial Protection and Innovation, and there are other state examples as well. Adding to this stew is the fact that regulatory winds are also blowing pretty cold on fintech. For example, the nominee to lead the OCC, Saleh Omarova, for example, in addition to intending to end banking as we know it, has expressed concerns that innovation may result in a weakening of supervisory standards. So expect the OCC to join other agencies in taking a very hard look at innovative lenders. So that's the bad news. Let's help you all out and talk about several things. First, let's talk about how these changes in the regulatory environment impact enforcement actions and litigation and heighten regulatory focus on automated underwriting models, including those that involve artificial intelligence and machine learning. And let's talk about model risk management. And finally, let's talk about what fintechs and other lenders can do to stay out of the regulatory crosshairs, or what they can do if they find themselves there. So we have a lot to cover. We're very excited. Let me mention, we have gotten a lot of questions, which we're going to address at the end if we haven't addressed in our discussion. If we run out of time, we're happy to follow up afterward. Okay, let's start with enforcement and litigation. Andrea, let me throw the ball over to you. In addition to a likely increase in the number of enforcement investigations and settlements, do you expect to see a return to more aggressive theories of liability?
I would say we'll probably see new theories, and it's in the eyes of the beholder about whether it's an aggressive interpretation or not, right? Many of us think that disparate impact in and of itself is an aggressive interpretation of ECOA, at least, where the Supreme Court has not spoken. But yeah, I think we will have no shortage of what Marsha and I refer to as the bread and butter disparate treatment cases, right? We've seen one redlining case already coming out of DOJ and the OCC. We have more in the queue that Marsha and I and others are working on. We see CIDs flying out the door and examinations at the various regulators and other kinds of exams going on that suggest there will be plenty of these that bubble up to some kind of informal or formal enforcement action. So, and these are just the things that we've always seen, in this space: pricing, underwriting, redlining, those kinds of things. So we'll see plenty of that. Will we see something new? Yeah, I think the fact that the agencies have asked, sent out the request for information on AI suggests they're curious enough to start to lay down some standards around what expectations are and how you use AI. And we'll come to that later. We also know with the advent of the small business data collection rule that they'll be probably pursuing those cases, but they're not waiting for data to come in. There are plenty of redlining and other fair lending cases that are founded in small business that we probably haven't seen much of in the past, at least in public actions, that we'll start to see that as well. Yeah.
Do you think it's fair to say that that Mick Mulvaney's narrow focus on disparate treatment, though, is kind of out of vogue?
Well, disparate treatment never goes out of vogue. We definitely know that. That's always been the safe harbor, right? I mean, that's what for many, many years, the regulators and enforcement agencies relied on. So now, so I would say that's never going away. The question is will we see a transition into more of a balance, or I don't want to say a balance, but more of a hybrid of cases that are disparate impact and disparate treatment, which we did not see in the last 4 years? Yes, we will see disparate impact come back. We have a mandate from the White House, and by we, I mean HUD, has a mandate from the White House to revisit the disparate impact rule. So in the mortgage space, we could certainly see that take a turn. But I think we'll see no shortage of disparate impact cases also moving in the direction of protections, for example, from people during COVID who were disparately affected if they belong to a particular prohibited basis group. We have seen some of the states, New York being one of them, that picked up the dealer markup guidance, where it was eliminated at the federal level. So New York DFS does not feel prohibited from pursuing dealer markup cases, which are heavily reliant on disparate impact. And we know that it's the servicing space, which we've been hearing for a long time, that it's coming down on us now, where we don't have data and we have kind of just some timelines around how default management works in mortgage or student. We're going to see some policies and models that are scrutinized for how those impact prohibited basis groups. So disparate impact will be very much alive and well, but we're not going to see disparate treatment go away either.
Thank you. Marsha, what are your thoughts?
I agree with Andrea. We haven't seen anything go away. So those past 4 years, I think everything slowed down, and we wondered where the spread would be. There was focus on the traditional markets a bit. As we all know, there weren't a whole lot of enforcements that we saw in the public domain. I think the other thing Andrea didn't mention, while of course we're going to see disparate treatment, disparate impact in both underwriting and pricing, the product space is quite broad now. So we see everything from the traditional mortgage to issues in the small business world, where of course that one becomes particularly challenging in terms of how you define what's protected and how you proxy in small business. But we see it across the board. So I think there has not been an area historically that has not been touched on already in the first, 9 months of this administration. And I think we'll see an expansion. So I'm with
Right.
Andrea on that.
So everything old is new again, and there's still some new areas to explore. Marsha, kind of thinking of a new area, what do you think of Chopra's stated view that disparate impact may also constitute a UDAP?
So typically speaking, I don't talk about UDAP as much as Andrea does, and we don't see as many UDAP cases as Andrea. Having it defined and deciding exactly what it means in practice has always been a challenge. So I think that this agency under Chopra are going to try to push the frontiers on everything they can look at. And if they can bring some under that UDAP umbrella, they may try to do so. Is there precedent for that? Again, I'm going to defer to Andrea on that, but we haven't seen much of it. It hasn't happened before. It's not something we've seen cross our desk on a weekly basis. So I will be interested to see how they're going to define it and how they will measure it, if that's going to be a focus of his after confirmation or when he moves over next week.
Andrea, what are your thoughts on using the UDAP theory in disparate impact?
Well, if you kind of take a look at a smattering of orders under Courchane, it was not at all unusual to see the piling on, if you will, I call it the piling on, of a UDAP on top of a FCRA violation, of a RESPA violation, of a Reg DD violation, right? I mean, they tended to go hand in glove. And interestingly, we didn't often, I can't think of actually a recent example of a case where ECOA and UDAP were used for the same claim. Now, we've seen orders where UDAP and FCRA or ECOA were together, but they kind of dealt with different practices. So that's not unusual for them. But there are a lot of reasons why UDAP is leveraged in terms of an additional claim. Sometimes it is to create an additional restitution pool, right? Like it allows you to capture a broader population or more fees or more interest that ends up going back to somebody. Sometimes it gives the agencies an ability to reach back farther if there's a statute of limitations barrier there that they're trying to push through. So there are lots of reasons why they do that. I don't think that's actually what the legislators intended when they enacted the FTC Act. I don't think this was intended to be a compounding effect. I think it was intended to capture claims that weren't originally caught by ECOA or FCRA or RESPA or TILA, right? But nevertheless, I guess these agencies have the authority to interpret it and apply it how they will. I do think that they will go back to using considering anything that somehow, result in an adverse monetary result to a consumer, resulting, in a UDAP. The way it might come about, I think if we were to see this, would again probably be some scenario where a practice or a policy had a disparate impact or result on probably a pretty financially vulnerable group, right? Making it unfair or making it deceptive. And if it happens to correlate to a prohibited basis group, they will compound that with an ECOA violation. But yeah, I mean that you could, I don't want to feed ideas to the regulator, so I won't speculate about what that would look like, but I can absolutely see scenarios where there will be fact patterns that are available to them if they choose to pursue that.
Yikes. This is one of the unfortunate things about a Zoom webinar. If we were in person, I would expect to see the audience like making notes, call our lawyer, talk to the chief compliance officer, but we'll get to that. But okay, so even if it's sort of a shaky legal theory when it comes to fair lending, can you describe what a CFPB UDAP-based disparate impact investigation might look like from the perspective of the entity being investigated?
Yeah, I mean, my first instinct will be if this was something of interest to them where they might think it's one or the other or both, is it's usually a practice that they think is generally unfair, right? Is like this, something happened that was unfair to customers. And so then they might, now what often happened in the past was that was enough, right? Is this unfair? And regardless of what their race, national origin, sex, age was, is if it was unfair, everybody needs to be made whole. Right. And so often UDAP is a great dragnet for that, right? It's like, we don't care what your demographics are. If you were treated unfairly, you're going to be made whole. So I don't know I really don't know why it would be in a regulator's interest other than to just, again, have the opportunity to slap another violation on you. But to say, oh, in addition to that, right, a segment within the people who were treated unfairly just so happened to be concentrated in one prohibited basis group or not. So it almost kind of has a narrowing effect. So that's why I kind of feel like if we were to see it, it might be the reverse, which is like it was discriminatory against this group, right? And then, oh, and by the way, this group also was treated unfairly, and maybe that allows them again to pile on additional fees or penalties or anything like that.
I see.
Well, or if they could bring in one group that they couldn't because the practice isn't quite so unfair across the board. So one way you might see this, and you sometimes see this in some of the litigations out there that have a background in discrimination, is to say this group was unable, it doesn't have the knowledge or the experience to well understand what the policies are. And so by having these policies in groups that are less financially sophisticated, you actually are being unfair to that group. And there, if they can link it to the protected class, whereas otherwise they couldn't. You can't say anymore, I don't think, that mortgages are unfair because so many people have them and use them. But if you can say subgroups of them don't understand all the terms of them, then you can bring in something that's more unfair on the subgroup and combine it with fair lending.
One recent example I should add, just by the way, for those of you that are kind of in the trenches and, when you identify a practice, you're like, oh, we made a mistake, right? We need to make people whole. I have one financial institution that was self-identified an issue where people didn't receive the benefit of their bargain. I'll just leave it at that. And they remediated everybody who may have been impacted by that inadvertent practice. And the regulator came in and said, well, we want you to run a fair lending analysis on top of that. I don't know if it was mortgage or not, but setting aside the fact that whether they had GMI or not, is they're like, yeah, but we already made everybody whole, right? Like we already identified who was affected. And so it was unusual in the sense that for everybody who was made whole, one would ask, why do we need to go the extra step and to figure out if people in there tended to meet, one prohibited basis group or another, but you might start to see that. And so you might internally start to say, every time we find a UDAP, is this a situation where we should also see if there were any groups that were impacted more than others? It's risky, right? Because if you find the answer, what's the solution? All you've done is find another violation. You're not going to remediate because you've already made everybody whole. So I would caution against doing that, but you might hear from a regulator that they want you to run that analysis.
And when I was in the government, I had a long career writing regulations, right? Writing big interagency regulations, and safe to say, it's a pain, right? It is a lengthy, difficult process to get every agency on board to deal with thorny issues. One example would be things involving pricing, right? So I can see, UDAP is an easy catch-all in the absence of specific agency guidance around, like, what is a reasonable price for this? What is the reasonable markup, et cetera? So it's frankly just a bit of a trap for the unwary, and it maybe just addresses a vacuum in regulatory guidance, or gives the regulators a pass from out of being more specific in their guidance, I think. Marsha, were you going to say something?
Not on that issue.
Not on that issue. Okay. The beauty part for me of no longer being in the government is I can say provocative things about government. Okay. Andrea, can we go back to COVID? You know, what can we expect in regulators' focus on the treatment of consumers who are financially impacted by COVID?
Yeah. I would say anything's game, right? If I were to speculate based on kind of what we've seen out of the supervisory highlights and things that acting director Waggio may have said in blogs and other public statements, is the kind of the unholy alliance, like the nexus at which you do not want to be, is something where it had a fair lending implication and it was tied to COVID, right? Because this is, you know, the place where people, you know, who've been most, you know, impacted. We certainly don't want to have the amplification of the harm by it being race related or other related. So that's where we don't want to be. But I could see that being the perfect way to demonstrate for this bureau, you know, what they mean by, you know, making their enforcement priorities related to COVID protections and to fair lending and racial equity. But within COVID, if we were just kind of focusing on that in general, I would say mortgage servicing, because we've always known that they view a person's home as their most important, because, you know, that's the most important thing that they own. Housing, and interestingly, the CFPB is very focused on the eviction, you know, protections, even though it's not really lending. But I've noted, you know, with interest that they're very interested in extending those protections. But yeah, keeping people in their homes, and housing insecurity seems to be a nationwide interest of all the agencies. But not just because students are a vulnerable population, but because we know the new director was very deeply entrenched in student lending, so knows a lot about that, and probably has the ability to, with a lot of industry knowledge, be able to poke into that industry perhaps more knowledgeably than others. So student and mortgage servicing, will probably see some stuff coming out. And what does that look like? Probably a mountain of RESPA violations, notwithstanding best efforts, right? We were all doing the best we could as we quickly transitioned our entire offices, back offices in particular, to being remote. And coming up with all sorts of programs that didn't exist, and getting our systems all of a sudden to do things that they had never done before, and doing it overnight and doing it remotely. And, you know, the retraction of all of this guidance that was put out and now being pulled back, and the promises of grace and latitude seem to have gone by the wayside. And now their examiners are being directed to go back into the prioritized assessments and make sure that they cited every violation. Now, as far as I can tell, every bank I've worked with, and probably fintechs too, violated some law during COVID. It was impossible to get everything perfect. It is even in perfect circumstances, like notwithstanding a pandemic. So nobody got it right. Everybody made mistakes, and it was probably related to FCRA, which we will see some activity around FCRA because they're very protective of making sure accurate reporting these days. But the question will be just how bad. You know, they're going to pick some weak gazelles from the herd, and it's going to probably be, and we've seen some evidence of that already, right? You know, but it will probably be, you know, the more extreme examples where there wasn't just a mistake or even a systemic mistake, there was an intentionality to really take advantage of people. So if I were to say what we see coming out of COVID, there will, whether it be a co-related or just UDAP related, it will be, here's somebody who clearly took advantage of the situation. And that's kind of the, you know, the poster child of abusiveness under the, you know, Dodd-Frank Act. And they'll make examples of some people with probably some pretty hefty penalties and restitution expectations.
Yeah, in my practice, I have one client whose collection practices are being heavily scrutinized for, you know, what happened between the time a customer raised their hand and said they were financially impacted. You know, a very, very thorough investigation around, you know, their collection practices. And so that's an area of great interest. Marsha, what are you seeing in there?
Mortgage servicing. So, well, two things. Mortgage servicing, I think, will continue to be an issue, obviously. It was hard enough during the HAMP years when everybody had theoretically these federal guidelines as to what to do and how to do it and how to move people out of particular situations or modifications or, you know, forbearance situations. So, and it's one thing to say, look, COVID came upon us suddenly and we all scrambled and we were all remote and we had to adjust very, very quickly to people not being able to make their payments. There will be, I think, less flexibility in mistakes happening as we move people back to payment, to full payment plans, to move them out of modifications or forbearance. You've had time to think about it. You've had time to set up your systems. Let's hope they're right and that they're done well. We're also seeing activity still on the PPP program. You know, who got those loans, who was eligible when they walked in, did it go to their own customers, did it go to others, was there here a disparate impact, can you measure that? So I think the small business and the mortgage servicing, now mind you, those are ones where there's a lot of data available, so I think perhaps we see those more than some others might because we crunch
right.
numbers. And I wouldn't know the illegalities of everyone getting it wrong. FICRA, however, I anticipate seeing a fair amount of activity. We see FICRA activity over issues I can't even believe became issues, and multiple, issues. So here, this is rife for problems because the rules were put into place quickly. They were complex. It took a lot to make it through those, even with guidance. And I expect those three areas are the ones we're going to see most of the activity, some of which will play out in the regulatory space with examinations and enforcement. Some of it's going to go straight into and has already moved into the litigation space.
Yeah.
The consumer groups will absolutely leverage the agencies, right? I mean, if people hear me talk about this, is they didn't really have a willing partner for 4 years, right?
Correct.
Whether it be
They do now.
right? They do. I mean, and they have limited resources, and we just saw millions of dollars of HUD grants going out, for example, out the door to all the groups that bring these claims, right? And they just kind of started, right? All they do is pull the thread. They either do some mystery shopping, they do some basic analysis, they collect some information, they talk to some complainants or customers, right? And so they get something, right? And they can hand it to your regulator. And they do, or they could hand it to an enforcement agency, and there's no shortage of agencies or journalists that are happy to carry the water. So I think that there are going to be a lot of partnerships right now between those in the consumer protection, nonprofit sector, as well as the government coming together to pool their resources.
Yeah, and the allegations
again,
go
ahead, Marsha.
Oh, I was going to say, as soon as they get involved, there are a lot of allegations floating out there. And so they will file complaints full of allegations. There will be reports of those allegations. And those aren't always followed to the end, saying, but this class wasn't ever certified. This didn't actually turn out to be a problem. The reputation right up front can be an issue for everybody. And so being on top of it, doing your own analysis of what happened with respect to all of the COVID protections, I think is critical.
But what I would caution people to think about is, if you think you are having a private conversation with a consumer group, you may be, but you probably are not. Meaning that they can absolutely be talking to the government at the same time they're talking to you. And you may say, oh God, okay, at least they haven't filed a lawsuit yet, or they haven't filed a press release. Do not assume that they are not having conversations behind your back with the government at the same time. So be very sensitive to saying, oh, just make this go away, nothing bad will happen. Something may still happen even if you enter into a voluntary conciliation agreement.
Not that we're cynical here, Andrea, but that is what we see play out over and over again.
Yeah. In my practice, I've seen consumer groups proposing to conduct their own fair lending investigations of lenders, something that would have been in my day at the OCC an absolute non-starter. That's what the examiners are for. And I think the environment has shifted. Not
only that, but I've seen the regulators, when they know a bank gets into a private agreement with a consumer group, the OCC will track the financial institution's compliance with a private agreement, saying, are you honoring your commitment to that organization?
So how I said that it was too bad we couldn't see the audience making a note, to call their lawyer. I feel like what we should be doing is having this discussion over drinks, because it's a little bit depressing. So, but
next time
it's going to get better. Audience, it'll get better, but not quite yet. So let's talk about the states. Okay, I mentioned the California DFPI. And some other sort of similar, I think let's talk about the DFPI. What do you think its focus is going to be? California's a big state.
They're coming out. I think they just had their first settlement announced kind of under this new statutory framework they have. I mean, they go after UDAP, a lot, but I think under the new framework that they operated, they've gone after a company with an action. But yeah, I mean, not speaking of kind of like, pooling resources is I think that we will see them absolutely bringing their own cases and opening their own investigations and bringing their own cases, whether it be UDAP or discrimination or any kind of other customer protection issues. But I think that they're very prepared to start partnering with the CFPB, which then creates a scenario where there's a much broader reach, right? I mean, yes, it could be California specific, but it might be California and the New York DFS and maybe, the Illinois, state. I mean, there could start to be some really odd configurations where there are a lot of resources coming together to have a very broad reach. So I think the states will be working independently, and they will also be working in concert with each other.
To me, one of the scariest things about the state in which I live, about California, is California 17200, which, for those of you who are not familiar, is a bootstrapping provision where a violation of any law can also constitute a UDAP. Talk about broad,
Well, and we've also seen in California some interesting cases that really get into immigration status and citizenship, which really don't technically fall under ECOA. So we might start to see, depending on which agency wants to carry the helm, some more of that as we have these directives from the White House to really close the gap on racial equity in dealing with those issues, because not all federal laws will allow them to go after people on immigration status, but there are definitely state laws, including California, where you can do that.
Right, because under ECOA, your status as an immigrant is not a protected class.
Right. No. Although I'm not sure that they're not going to find ways to get through that too.
Yeah. Okay. One last question on sort of the enforcement and litigation before we shift over to a more technical discussion of AI and model risk management. Do you think we're going to see a shift back to resolving claims through enforcement channels in lieu of supervisory processes?
Maybe I just say yeah.
Yes.
I mean,
yes, we do. We're with you on that one.
We're in violent agreement. And in fact, I haven't spoken on a panel since the new administration took over where there was a dissenter, right? I mean, I think that there is.
Yeah, I have heard zero dissent on that front.
Exactly.
Yes.
And, to the extent anybody is on the phone or on this call who's from the government, I mean, I'll tell you why I struggle with this, apart from the fact that banks and other fintechs and, we're generally trying to do what we're supposed to do, right? So tell us what to do and we'll do it, right? But this whole idea of just kind of like finding 1, 2, 3, a handful of companies that have done something, applying an interpretation of the law that we haven't seen before and saying you should have known 5 years ago not to do that is not a great way of helping everybody fall in line, right? And we also know, if you've ever negotiated an order, that those are not all the facts, right? I mean, the government reserves the right to put in orders their recitation of the facts. It's not balanced. The company does not get to say, okay, well, here's our side of it, right? They can put out a press release, but you never really know how things come about. And so we're left to kind of have this patchwork of incomplete facts and extreme examples, right? Because usually they pick the more extreme examples. And then we're supposed to say, okay, well, that's the extreme side. What's the moderate side? And where's the line about what I can and can't do? All I know is what I know. I know exactly what I can't do. They just pointed the finger there, but I don't know enough to really say, how do I incorporate this into my compliance management system? So there are a lot of reasons. And by the way, by only using extreme examples, those that look at that and say, well, we didn't do that, we don't have that problem, right? I mean, and it creates almost a false sense of security, which is like, well, we're not that bad, so we don't have a problem, right? But maybe you actually do have a problem if you just strip some of the inflammatory press release narrative out of this. You're like, oh, we actually do that.
Or if you knew what the line was, if there was a line. So it's not that they're only extreme, it's that you don't even know how far down that distribution of extreme they are. Were they in the top 5% of bad actors? Were in the top 1% of bad actors? So you can't, from the enforcement agreements, figure out anything much.
Right. And again, that goes back to my comment about in the absence of clear regulatory definitions, fintechs and lenders struggle here. And actually, even though I know I said I was going to hold the questions till the end, this subject highlights one question that was perhaps my favorite submitted in advance. So whoever submitted this, thank you. Can fintechs get regulatory blessings through the CFPB advisory opinion or other processes and have the blessing apply to all of the fintech's clients by extension? The answer is no. Would anyone care to comment? Would that it could be so simple. And not only will it not apply, broadly, it won't apply to other lenders. This is not the process that provides a lot of comfort. Are we all in violent agreement on that one?
Well, I'm in agreement that the idea that there's ever a blessing of anything is quite a stretch in the first place.
Yeah.
So if a fintech had let's take a sandbox, right? Assume there's a sandbox process, assume there's an Office of Innovation, whatever you want to call it, process, where they're looking at issues in fintech and they're making a decision about, well, in that particular respect, for that particular product, we don't see an obvious problem with your model. Let me just point out that's at a point in time. And fintech models, if nothing else, rapidly change. And their applications might change with each and every lender. And so this idea that there's a blessing, even a fulsome blessing in the beginning, much less over time and across fintech clients, I just don't see it happening. Not in the next 4 years anyway.
So the person who asked that question has made a note to call the lawyer, poured himself or herself a drink, and is considering exiting the business. Sorry, but hang in there. We're getting to the good stuff.
By the way, I agree with everything Marsha said, but I will just caution people is I'm glad you've heard what Michelle and Marsha have to say. That does not stop companies from promoting safety and security of their own advisory opinion, from saying, hey, come work with us. We have this warm safety blanket. Be very leery of that, right? I mean, we already gave you the reasons to be cautious about that, but that does not stop people from promoting
their products.
Or that, a somewhat kind of like, veiled reference to insulation from regulatory scrutiny. It just simply isn't there. So be very leery of those.
Regulatory comfort is hard to find. Okay, so let's get our geek on, ladies, and talk about AI and model risk management. Marsha, this is really where you live, Andrea too, but advancements in AI, including machine learning, offer great potential for expanded access to credit. Marsha, let's start with you. What are the fair lending benefits and risks involved in these models?
So let me start out at a somewhat even higher level than that. So let's go to AI and machine learning. The benefits could be great in terms of access to credit, right? And for a couple of reasons. One, the models are great at being able to refine predictions. They might do better risk profiles of exactly what you have. They might be able to pinpoint risks in a way more traditional models with limited controls cannot do. So they can be used for big refinements in terms of underwriting and pricing. The high level problem I see is much like when the mortgage world, and I hate to refer us to the dark ages, but remember when mortgages blew up, right? So we're back in 2002. Everyone is pushing better access to credit. We need better access. Home ownership rates are low for minorities. We must do things to help them. And even the GSEs were like increasing LTV levels. They were allowing people with lower down payments to get in. They were allowing lower credit scores to come in. And the regulations followed by years from what we saw in practice in the market. So while the regulators talked about some very obvious issues, say with subprime, we didn't see a fulsome look for 2, 3, 4, 5 years. And by then it's too late, it all blew up. So in the fintech space, the benefits are there, but the regulation, in my mind, is not. So there is a lot that can be done. If you even start to open the literature on this subject, and you can find long surveys of the literature, all the various techniques, every data scientist coming out of an undergraduate institution can program in Python. Not that 89% of them know a thing about lending or the laws around it. So the techniques are there, the skills are there, the ability to refine models is there. So you can use this really powerful tool to move the envelope a bit.
Mhm.
And those benefits are obvious. So I think in terms of being able to better nail what the risk is of default, you can improve underwriting to be able to price at the margin. And I hate to use the word, price in anything but a generic sense, but risk-based pricing. We've had that forever. How you use it can be a benefit here. So people that we wouldn't have allowed in before at sort of a low prime rate, we can very precisely price now into different categories. And that's a plus too, because they might get the product even if they have to pay more. But the risks are enormous because to the extent you can price more categorically and smaller iterations at the margin, you can, of course, also mean mispricing particular subgroups of people who might have characteristics that are not obvious to a data scientist as being a problem from a fair lending point of view, but correlated enough with race that it could be a fair lending issue. We are frequently asked when looking at the list of 975 variables a fintech has in their pricing model, well, do you see anything obvious? We're not using race. We're not using protected classes. What do you see that's a problem here? And we're like, very high correlation with race. Well, what's the standard? Well, what is it? Is it 75%? Is it 85%? Well, what is it? What are the regulators saying? And we're like, the regulators aren't saying anything. The problem is they might be building groups. They might be bringing in advisors across agencies, but they're not saying anything. There is no standard out there on how big a correlation has to be before it's a problem. There are no standards over how much marginal pricing there can be. There aren't even standards on how you do the trade-offs between the efficiency and the equity along that frontier. So
Right.
the risks are huge. The regulators could shut down all of machine lending if they felt like it, because there's no understanding of exactly what these cutoffs are. And would that one could say, look, they haven't said anything, we're okay. I just point you to the proxy methodology. They introduced it at the BISG in 2013 and they apply it retroactively back to 2008 or 9. They don't need to have the standard in place already to object to it. So big risks, big returns. I love the technology. It's wonderful. Our staff finds it interesting and fun, and it's powerful. So I view it as a real mixed blessing, to use that blessing term again. You can do a lot and you can get burned. So be careful.
That was a beautiful summary of where we find ourselves. Andrea, let's talk about data bias, right? Data may reflect past bias or historical inequities. Can you just talk a little bit about in terms of like feature analysis, outcomes testing, et cetera?
Sure. Yeah, I think that just starting with an openness to the strong likelihood that many data points that not just financial service companies, anybody in any industry, right? If we have historical data, there's bias baked in there, right? Unintentional bias, but we're surrounded by it. So starting with the premise that many of the data points that we're starting with already have bias baked into them, just understand that then even if you have a black box, right? Even if you have an automated system and there's no judgmental element to it or overrides allowed, you may still have disparate impact on the back end, right? Unintentionally so, right? But it may still be there. And so, I mean, that really explains why the regulators will most likely, because they do this kind of with any kind of use of technology, is expect to have preventive and detective controls around what you're doing, right? And that's in anywhere from making sure your modelers are trained on what attributes are appropriate to use and how to build and weight their models and so forth, and how to validate them, how to include compliance at the table when you're doing this, but then on the back end, right? And it's kind of like, okay, we built the best model that we could. What came out of it, and you may be surprised, right? And even what you predict may be something that you didn't intend. And it's not just because any individual attribute that you used went in was neutral as to all the prohibitive basis groups, but some combination of them, or the weighting of the attributes, and then again, or both. And then on top of that, just the fact that might be a product of the bias that was in just the original data that you got. And now that we're in this world where they're just terabytes and terabytes of data, I mean, just there's no shortage of it, that it can all be used. I mean, it's all in as long as it's not a prohibitive basis factor, but it doesn't mean that it won't have a disparate impact for a whole host of reasons, what we've already talked about.
And there are techniques for trying to debias in these machine learning models. But let's keep in mind that the data scientists at step one are really doing this with their hands tied behind their back, right? Because they can't know or use the race and ethnicity, for example, in building those models. There can be a second line behind them or an independent third party out there who can then say, does your model perform as well for these subgroups and what does it mean? But the people building the models in step one can't do that. To the extent they can't use any of the protected classes in building the model, there always has to be the second look later on by some other line of defense. And that's a problem. You can try to do it simultaneously with two people sitting across a workspace and a firewall, but it is a challenge. And it's even a bigger challenge outside of, I'd say, the mortgage space, where even the people in the second line or the third line or, the independent third parties, now we're talking about proxies and how good those are. We're using 2010 information for proxies, right? Who even knows when the 2020 is going to be usable for proxies? But our underlying distribution of races and ethnicities is changing in the US. If the proxies are weak now and the proxies themselves are biased, and then we can't use them to build, but we have to use them to evaluate, it's a mess. And regulatory guidance, I think, is desperately needed. Clarity, anyway. Even if you don't like the guidance, clarity would be nice. Transparency, clarity, all the things they want to see in models, I think all of the people doing the modeling would like to see in regulation. So there's this balance. It isn't working real well right now, in my opinion.
I will echo what Marsha said and also say, I think that in addition to, the clarity on guidance is just also, I think that it's unclear whether financial institutions are expected to always do testing of a model before it goes live, right? And what's the value of that anyways? And particularly if we're proxying, right? Like if we're just kind of trying to predict, like, okay, so maybe we have a model that doesn't have live data yet, it hasn't gone live, but we're supposed to use kind of some historical data to test it. And if it has an adverse result, do we got to start at the drawing board again? Do we have to start swapping out attributes before we can get to some it can be paralyzing for institutions that are really heavily reliant on their models, either for pricing or underwriting or fraud detection, whatever it is. So I worry that we're going to start to get back into the swing of things with disparate impact, where it has this paralyzing effect. I would argue that, the last administration, or at least under Kraninger, they really viewed AI and technology as a bridge to closing racial inequity, right? And really finding a way to get into untapped markets, underserved markets. Whereas this new group of people in leadership are really looking at it much more skeptically. And if you've listened to the Federal Reserve Summit on AI, and Lyle Brainerd made some very good points, but now you're seeing that kind of like this is a double-edged sword, and it can do good and it can do bad, whereas it felt a little more positive in the last administration. So that might mean where there are a lot of expectations about how safe is this model, right? How fair is this model? And then what's their assessment of fair, because we're using proxy data? I mean, I don't think that that's a fair judgment of whether a model is bad.
And I think unlike some of the traditional models we've seen up until, say, machine learning AI, most credit risk departments, even of smaller regional banks, understood the variables that went into them. So if you're looking at LTV and DTI and credit risk and all the things HMDA collects, I think there's a very good understanding of what those are and what they might be useful for doing in terms of predicting default. Now, I think it is the case, for better or worse, that the techniques are not those that a lot of people working in smaller institutions have themselves the capability of developing and producing. So there's much more buying from an outside vendor. The outside vendors are very reluctant to even share what variables are in their models or how they're put together, because they view this as intellectual property. I'm the fintech who did it better than the other 33 fintechs down the block. And so for you as a purchaser of this kind of model, it's hard to get really good insight into what their black box is. So again, we've had decades of knowing FICO, Experian, TransUnion, there are black boxes, Vantage, but we have an understanding of the basic range of variables in them. Take all those variables and now add in the social media data and the macro data and everything else out there. And then don't tell people, are you doing a particular kind of gradient boost model? Are you doing a neural net? How exactly does it work? I don't want to tell you because that's proprietary. Isn't an answer that's going to fly a whole lot longer, I don't think, because you're not going to be able to say, yes, they can all churn out adverse action notices. The people selling these products can do that, I believe, in various and sundry ways. Not sure that it always makes sense, but they can do it. The question is, do you understand what's going on? And just to overlay this whole conversation into the whole world's changing around us, on top of all of this, these models, many of them were developed pre-COVID,
Right.
and then COVID hit. So how will they even predict post-COVID is a question to keep in mind and ask as you're doing this. Have they been redeveloped? What does it mean? Will the world change again next year? So I think it's a mess. It's a fun mess in some respects, but not if you're paying out millions in a settlement with a regulator because you didn't understand exactly the world you were now living in.
All right, ladies, if in case our audience, if we haven't lost them all and they're, drinking at the bar, let's do a little bit of a speed round of positive steps they can take. I'll kick this off, but please jump in.
Michelle, before you do that, let's ask this one question came in as we were talking. And here's one for everyone on the phone. Why can't programmers use protected class to build the model?
Oh, yeah, go ahead and take that one.
I get you can't discriminate, but what does building a model with protected class information do? It's illegal. So I turn it over to you, Andrea.
Right. Well, yeah. I mean, somehow back in 1970, when they were writing ECOA, they wrote it broadly enough to say you cannot use a prohibitive basis factor in any aspect of a credit transaction that is adverse to any particular prohibitive basis group, which actually even protects, for those of you that are kind of just dipping your foot in the pool on ECOA, that means you can't even reverse discriminate against white people or against men or against, a particular age group, no matter whether you're in the control group or you're not in the control group. You can't take any of those things into consideration in any aspect of a credit transaction, which is pretty broad, including models.
Don't do it. Don't go there. It's like the third rail. Just don't do it. Okay, so positive steps. Let's do a quick, kind of round robin. Let's start with your risk assessment process, right? Update your fair lending risk assessment process. Have an expanded view of risk from a fair and responsible banking, FARB, and a UDAP point of view. If you're limiting your focus to traditional fair lending concepts and risks, you're not adequately preparing for regulatory scrutiny. Let's talk about documentation and testing of controls. Marsha, would you like to talk about that? Andrea?
I think it's really important to have, so I try to recommend two things. Internally, your own people need to know exactly what you have in there and why you have it in there. You have to have incredible detail and precision And this is sort of common sense model risk management. There's
Yeah.
a reason why there's model risk oversight. Your people, the executives who are using your model to make big decisions about how that company is going to work and perform and, target people, you need to be clear that they understand. And then even if you don't want to tell everyone your secret sauce, not that tree boost models are secret sauce anymore, but there you can be a little more broad, but you have to at least say all of these were bureau attributes. These came from here. Is it representative of a population at large or not? So at least talk about where the data came from, what population and time period it came from. And so the broad controls about its representativeness are out there. It will help others make decisions from a model risk management point of view.
Yeah, another thing, on the testing, right? Let's talk about both pre and post implementation technology testing, for responsible innovation. Testing that for potential discrimination, Andrea, in marketing and advertising, right? Let's talk about the potential for digital redlining.
Right. Yeah. I mean, there's a lot of literature out there on that. My friend Dave Scanderson at CRA has written on that. I guess I would say this might be, we talked at the beginning about what might be an emerging area in fair lending risk and exposure. I think digital marketing is one of those, digital redlining in particular. And if you're wondering what that looks like, it's very hard to pin down because it's not exactly, we don't have a lot of examples, of where the regulators have gone after it. But if you think of it as, using the data that you have to identify your target markets, and whether intentionally or unintentionally you're leaving out minority areas, is just like kind of regular redlining that we're used to, is like, are you only reaching out to the affluent in the predominantly white neighborhoods? And even though it was unintentional because it was digital, there are ways that you can somehow use your target market criteria to not reach the minority market. So the answer is how was your strategy developed? And then what are you doing to make sure that if you are seeing evidence that you are ineffectively reaching out to markets in a fair and compliant way, do you have supplemental strategies? Which doesn't mean you have to have the perfect strategy that reaches everybody in the right, proportion, right? Like that's really hard to predict, particularly in the way digital marketing works these days with auctions and all sorts of algorithms. But it might be like, we think that there's something about our model that is not getting the diversity that we want. So we are layering on top of that an additional targeted marketing strategy that ensures that where there are gaps or lumps, we're kind of smoothing it out. So that's my recommendation: is don't find the perfect model, find a model that kind of suits your strategy. And then where you have gaps, find strategic ways to fill those gaps.
Correct.
What about, Marsha, what about steering and application and origination? How do you test for that?
For which one? So those are three different things I'd say. Getting in your applications, you can test like Andrea said, right? I mean, you can take a look at what you've gotten in. You can take a look at, so people don't always know why they got the application. So you could actually survey customers and say, did you come in because you knew somebody, you saw an ad, whatever? How effective was my marketing in getting in the application? The steering issue is hard to assess depending upon what you're looking at. So if it's mortgages, there's only a few products out there anymore, and they're really different in terms of where people get fit in. So we don't see much of interest when we're looking at steering and mortgaging right now. In the other ones, though, in the fintech products, there are some very different levels of products, and you have to know why you were fitting that person into that product, or the opposite, which is they'll say everybody pays the same price, and this is it. There's one price. We only price with one price, one interest rate, which is the highest possible interest rate, let's say. And so we aren't discriminating, but you are in a sense, because if somebody was low risk and they paid that high price versus somebody who was high risk and they paid that high price, there's an impact. So you can measure all these things, Michelle. It's just a challenge. We're probably
Yeah.
running out of time though.
Yeah, you know what? And I see a question about whether a transcript is going to be available. This webinar has been recorded and can be shared with attendees if you would like to listen to the unholy alliance of the three Midwestern ladies who've been leading leading this discussion. It will be available. I think we have to wrap. I am sad to say we may have to schedule another session to get to some of the other positive steps you can take. You can also call us all for advice. We work together, and we would be happy to hear from you. Any closing remarks?
I just want to
Andrea,
say thanks for putting this together, Michelle, Andrea. It is always a pleasure to work with both of you. I like that you think outside of the box, and it is so much fun having a webinar that's not scripted slides. So, and thanks to all of our participants for putting up with our cynicism and our skepticism about how the world works. But we hope we can help you through it. If you have any issues, email any of us. We're happy to take your questions, and we will put them through to the right person if one of us isn't the right person.
right.
So just, reach out if you need any more assistance, help, or anything else. And thanks to my team for helping do the technology behind all this.
Yes, thank you very much.
Ditto. Thanks, guys.
Thanks, everybody.
Bye.
Bye.
Bye.